The January jobs report showing that the labor market remains resilient, with unemployment falling to 4% and wages rising more than expected. And we saw job growth was even stronger than previously reported to end 2024 with those latest revisions. Let's send it over to our very own Jennifer Schonberger, who's joined by Chicago Fed President Austan Goolsbee. Jen.
Thanks so much, Shauna. And thank you, Austan, for joining me today on Jobs Friday. It's great to see you.
Absolutely. It's great to see you.
Austan, I want to kick things off with your reaction to this morning's jobs report. What really stood out to me was that the unemployment rate dropped to 4%, even as we saw that non-farm payroll number cool on the top line. Meanwhile, wage growth surprised to the upside, and we had some major revisions revised upwards. So given all of this data that we got this morning, how are you viewing the state of the job market now? And do you think that employment can be sustained at these levels?
All of those are important questions. As you know, every time I come on here on Jobs Day, I say, let's not get too worked up over any one month. And that's especially true for January, because there are a whole bunch of revisions that take place in January for the previous year. Now, that said, I think this was a solid report. It was close to what was expected. The unemployment rate ticked down a little bit. Taking all the broad measures together, because we got some question marks on any one of them, taking them all together, to me, it really feels like it shows we're settling into something like full employment. And that's a better spot to be than the one we were at, let's say, 6 months ago, where unemployment was just creeping up, and we were trying to figure out, are we about to continue and move into something worse?
You said we're settling into full employment here. President Trump announced 25% tariffs on Canada and Mexico, only to pause those for 30 days. But we have seen 10% tariffs on China implemented and remain in place. Given the potential uncertainty for tariffs to come back on Canada and Mexico, for tariffs on China to be even ratcheted higher, and the fact that we already are seeing tariffs implemented on China, how do you think that impacts the outlook for the job market?
But adds a little uncertainty. As you know, the Chicago Fed is the 7th district. We're heart of the Midwest, and as I say, we're like the Saudi Arabia of auto production. So I was just in Detroit talking to major auto suppliers and some of the major auto companies. The issues of the potential for escalating trade war being a wrench thrown into the supply chain is very real. It's on their minds. I'm hopeful that we have more experience like what we saw this past week or so, that for all of the argument, it ends up not being a big impediment to actual trade. I think if you look underneath the surface of this uncertainty, that really the job market looks like stabilized at full employment. We have solid growth. We have very solid productivity growth. Wage growth is about consistent with 2% inflation. And as I view the new months coming in, we've been getting good news on inflation, that it looks like the path to 2%. So if we don't have too much policy uncertainty about tariffs, about geopolitics, and that sort of thing, I'm still pretty comfortable with the path that the economy's on.
A couple follow-ups there. One, we are seeing inflation expectations ratchet higher this morning. Does that impact how you view the path for inflation and what that means for rates?
It could, but let me just emphasize the inflation expectations measures that are moving are these consumer survey of inflation expectations, and they're just for the short run, just for this coming year. That's less influential on my thinking than the long run expectations, and I've highlighted the market-based measures as being what I look at. If you started to see those market-based measures of long-run inflation going up, I would put a lot of weight on that. But those have been anchored absolutely solidly at exactly the target. The market believes, and the long-run expectations are not changing, believe that we are going to get back to 2%.
Austan, you said in a speech this week that if we see inflation rising or progress stalls, it's going to be challenging for the Fed to try to discern whether it's coming from overheating or from tariffs, and that, quote, the distinction will be critical for deciding when or even if the Fed should act. So if inflation is indeed coming from tariffs, would the Fed not act?
Well, my argument was, if you just look within the, let's call it economic theory, in principle, if it's a one-time tariff that increases cost but doesn't keep going and there's no retaliation, that's a transitory inflation shock. And I use that word with a little hesitation. In a way, you're supposed to look through, as a central bank, something that's only a transitory shock. But the hard part, if we were to get big tariffs, the hard part is trying to figure out, well, which part of the inflation is transitory and which part is permanent that you should be paying attention to. As I say, what my hope is that we don't see a rebound of inflation. But if we're going to add this policy uncertainty and we do start seeing a rebound of inflation, that's going to be a much more difficult situation, a foggier, dustier kind of environment. It's going to be hard to see the through line.
Do you worry that the 10% tariff on China is going to increase supply chain costs? And what are you forecasting in terms of the overall impact on inflation? You spoke to that in your speech this week.
Look, I have some worries. But it's that's a job as central banker. If you say, what keeps you up at night? You're not supposed to sleep at night. You're supposed to be up running through every scenario that could happen. We still have to see what goods these tariffs would apply to, how long they would last. Is it just going to be on China? Is it just going to be 10%? We do have the experience of 2018, in which tariffs on China did not have a very big material impact on overall inflation. So it could be similar. It could follow a similar pattern if we just stayed where we were. But that's the one where, as I say, you brought up this speech I gave. In that speech, I said the only thing we can do is just get out there as data dogs and pursue the industry expertise, talk to the people in these businesses, and use our industrial expertise from within the Fed to try to figure out under the hood how big are the supply chain impacts going to be.
Uncertainty aside, it seems like you said we're at full employment here. The economy's in solid shape. You know, given all of that, where do you see the path for rates now? Does that mean that you may be on hold for some time?
Look, we may be on hold. But I see over the next 12 to 18 months, if we can get out of the uncertainty coming from policy or from geopolitics and commodities, I view the long-run settling rate for the Fed funds rate to be a fair bit below where it is today. And if you look at the dot plot, there's pretty wide consensus that the neutral settling point for rates is down. I do think the speed at which rates would come down is going to be a little slower the more uncertainty and fogginess we add to the picture here. But overall, I still think we're on path to get back to 2% inflation. We've had a couple of months of pretty solid readings. In this 12-month trailing average on inflation is the only thing that's seemed to, in my mind, show that we've stalled out at too high a level. And that's mostly because of base effects, that in the first quarter of last year, we had a bump up in inflation. So if numbers keep coming in like the ones we've seen in recent months, that will start dropping pretty significantly as we go through the first quarter. So that's kind of where on inflation my eye is watching that.
Hey, Austan and Seana, just jumping in here. So it sounds like there is still a very strong case then to cut rates again this year. I have said over a 12 to 18 month period,
my view of where is neutral is well below where we are now. In the summer, I said it was hundreds of basis points. We then cut 100 basis points, so that was a good way to start. And I said I thought it would be natural if there's disagreement, if we're trying to figure out what is the stopping point, that we might start slowing down, having some pauses, trying to feel our way to where is neutral. Because, as you know, monetary policy works with a lag, so you can't just precisely hit it and do it all in 1 month. But I still think that left to its fundamental devices, the natural settling point for rates is below where they are today, and we got to get there on a judicious timetable.
Austan, I'm curious just to get your thoughts on some of the commentary that we got from Treasury Secretary Scott Bessent earlier this week. And he very much said he's not worried about the Fed, or the Trump administration isn't focused on the Fed. They're more focused on lowering yields. And I bring this up in the context of, how do you view market rates in context to policy, and what is necessary?
Yeah, I found myself in agreement with most everything that the Secretary of the Treasury was discussing. That he said they had an eye on trying to get long rates down, and the way they wanted to do that was upping the productivity growth, deregulation, trying to increase the growth rate of the United States on a sustainable basis. That it wasn't an argument with the Fed about what the short rates should be. As you know, the long rates, which are the most impactful on business investment decisions, on mortgages, on things like that, there are a lot of market factors that influence it. What are the expected long-run inflation? How much Treasury issuance is there going to be? What is it going to be, a shallow or a steep rate cut path on short rates going into the future? And then what's productivity growth? What's happening in the rest of the world? All of those factors are driving long rates. I don't think the Fed's mandate is about setting the Fed funds rate and the short rates based on maximizing employment, stabilizing prices. We take fiscal policy as an underlying condition in the economy, and conditions change all the time. So our job is to run through scenarios, process that information, and set the short rates. What's happening in long rates is in our forecasts and is in our evaluation of the conditions, but that's not our target. Our policy target is not to go move the long rates. It sounds like that's more Treasury's target.
Austan, how far are we, given what you just said, from neutral? And you said that you think that we're going to end the year with rates lower, assuming we don't have any major changes in policy that could affect the path forward. So given that, would we end the year at neutral, or is that something that's going to take more time?
I think it's going to take a little more time. Loosely, if you take the long-run settling point out of the dot plots, there's disagreement over where it is, but it's still a fair bit below where we are today. And most of the dots suggest that this, if nothing else changed, or what they would view would be appropriate, is that over 1 to 2 years, we're getting back to something like neutral. What's going to determine how fast we can do that is what happens to conditions. And I think we're on path back to 2% on the inflation side. And as that inflation comes down, we can commensurately be cutting the interest rate. That's where my starting point, where my head is. But as I say, there's uncertainty about what the truly neutral rate is. Monetary policy works with a lag, so we're going to slow down and kind of feel our way down to neutral, and I think that's perfectly appropriate. There's nothing wrong with that.
Austan, before I let you go, what are your thoughts on the proposition of a U.S. sovereign wealth fund, and would the Fed play a role in that?
I don't think the Fed would play a role in that. I mean, that's a fiscal policy decision. If we've ever heard of one, that's something to be decided by Congress and the president. as you know, the Fed's balance sheet, there are laws that restrict what we're allowed to invest in. And of course, our idea is always safety, safety, safety. You've seen the statement put out by the FOMC that we're trying to move the balance sheet to be all treasuries, not even MBS. And so I would not think that the Fed would naturally be an asset manager of the sovereign wealth style.
Austan, I want to thank you so much for all of your insight today. So appreciate you coming on Jobs Friday. Hope to talk to you soon.
Yeah, it's always fun seeing you.